The very first trap every trader falls into is the illusion of certainty. When you look at a chart and spot a pattern, maybe a double bottom, a breakout, or a clean trend line, your brain lights up with confidence. Deep inside, you whisper to yourself, "This is it. This setup cannot fail." That inner voice doesn't come from logic. It comes from your brain's natural craving for safety. Human psychology is built to hate uncertainty. In the wild, uncertainty meant danger. If you heard a rustle in the bushes, you couldn't afford to ignore it. It might have been a predator. Our ancestors survived by quickly labeling situations as safe or unsafe. That survival mechanism is still inside us today. But in trading, it works against us. When a trader believes a setup is certain, the illusion feels comforting. Suddenly, discipline starts to fade. You increase your lot size because you know this trade will win. You ignore risk management rules because this time is different. In other words, certainty gives you a false sense of control. And that false confidence pushes you to take bigger risks than you should. The irony is that the market doesn't care about your feelings of certainty. What looks like a perfect setup can collapse in seconds because markets are influenced by countless unpredictable factors, news events, liquidity shifts, even random sentiment changes. Yet, traders keep falling into the same trap, mistaking comfort for truth. The harsh reality is simple. There is no such thing as a guaranteed trade. Every setup is only a probability, never a promise. The sooner you accept that, the sooner you stop gambling and start trading like a professional. One of the most dangerous side effects of the illusion of certainty is how it silently erodes discipline. The moment a trader feels safe, truly convinced that this trade cannot lose, the rules that once protected them begin to vanish. Risk management, lot sizing, stop-loss level. All those carefully built guardrails suddenly feel unnecessary. It starts small. Maybe you usually risk 1% per trade. But this time, because the setup looks flawless, you decide to risk 3% or even 5%. You tell yourself, "It's fine. This one is different. I can go bigger." At first, it feels empowering. You're taking control. You're confident. But in reality, you're not controlling risk. You're surrendering to overconfidence. The false sense of safety convinces traders to break their own rules. They move stop-loss levels farther away, thinking, the market just needs more room. They double their position size. Reasoning, why waste time on small gains if I know this setup will win big? Each decision feels rational in the moment. But underneath, it's emotional, driven by comfort, not logic. This is exactly how traders end up in catastrophic losses. The trade that felt certain is the one they risk the most on. And when it fails, as it inevitably can, the damage is devastating. Ironically, it's not the losing trade that destroys them, but the oversized position that came from breaking their own rules. Professional traders understand this truth. Deeply discipline is not optional. It's survival. The rules exist to protect you precisely when your brain tricks you into thinking you don't need them. The market doesn't punish you for being cautious. It punishes you for getting reckless under the illusion of safety. When the so-called perfect setup fails, most traders don't blame themselves. Instead, they blame the market. They sit in front of the screen, staring at the red numbers, whispering, "This doesn't make sense. The setup was flawless. The market is wrong." But here's the brutal truth. The market is never wrong. It simply moves. The mistake lies in believing that certainty existed in the first place. This is the psychological trap. Traders confuse high probability with absolute certainty. They tell themselves, "I've studied for hours. The pattern is clear. This has to work." But probability means there is always a chance of failure. By refusing to accept that small possibility, traders set themselves up for massive disappointment. What follows is even more dangerous. Instead of calmly taking the loss as part of the game, they take it personally. They feel betrayed. As if the market has disrespected their hard work. That frustration often triggers revenge trading, doubling down, forcing trades, trying to prove that their original analysis was right. But each emotional trade only digs the hole deeper. The real issue is not the loss itself, but the illusion of certainty that preceded it. A loss on a disciplined, well-sized trade is manageable. A loss on a reckless, oversized trade, fueled by false confidence, is devastating. Professional traders don't take failure personally because they never assumed certainty in the first place. They know every trade is just one outcome in a long series of probabilities. The faster you stop blaming the market and start owning your belief in false certainty, the faster you grow. The market doesn't owe you clarity, respect, or a win. It simply is. The only error is thinking it should behave according to your expectations. Winning feels amazing. The moment a trader closes a profitable trade, the brain releases dopamine, the same chemical that lights up when a gambler hits a jackpot or when someone gets a burst of social media likes. That rush feels intoxicating. And if one win feels good, 2 in a row feel even better. After 3, 4, or 5 consecutive wins, many traders step into the most dangerous mental state, the belief that they've figured it out. This is where the illusion of genius begins. Instead of seeing those wins as part of normal probability, the trader's brain interprets them as proof of skill, mastery, even destiny. The inner voice whispers, "You're not like other traders. You've cracked the code. You're special." That's dopamine talking, not logic. The problem is, this chemical high clouds judgment. Each win makes the brain crave more. And suddenly, trading is no longer about strategy. It's about chasing the next dopamine hit. Traders begin to trade recklessly, not because the setup is strong, but because they want to feel that surge again. Ironically, winning streaks can be more dangerous than losing streaks. Losses hurt, but they make you cautious. Wins, on the other hand, create euphoria, and euphoria blinds you to risk. That's why many traders blow their accounts not after a bad run, but right after a series of big wins. The truth is simple. A winning streak doesn't mean you've become a genius. It means probabilities lined up in your favor for a while. The danger comes when you forget that markets are random and start believing you're invincible. That's when the fall is just around the corner. After a few wins, the mental shift is subtle but powerful. Confidence turns into overconfidence, and overconfidence quickly erodes discipline. The rules that once guided trading, careful analysis, strict risk management, and patience, begin to feel like obstacles rather than protections. Traders start to skip steps. They glance over charts instead of studying them thoroughly, ignore stop-loss rules, or bypass crucial risk calculations. This recklessness is seductive because the brain equates risk-taking with the excitement of winning. The dopamine high reinforces the idea that taking shortcuts and trading bigger is smart. Suddenly, what used to be a disciplined strategy becomes a series of impulsive decisions fueled by emotion, not logic. Ignoring your own rules is like walking a tightrope without a safety net. Each trade feels justified because the wins make you believe you are invincible. The irony is brutal the more confident you feel. The higher the probability that the market will humble you. One misstep, one unexpected news event, or one sudden volatility spike can erase days or weeks of profits. Professional traders recognize this trap and treat every win as a single data point, not a guarantee of future success. They stick to their plan, respect risk limits, and do not let a streak of victories cloud their judgment. The key difference between amateurs and professionals is not skill, but the ability to stay disciplined when emotions run high. In trading, excitement is a warning sign. When your brain craves more wins and shortcuts start to feel appealing, it's a signal to slow down. Success comes from consistent, measured decisions, not from chasing the thrill of dopamine highs. No matter how confident a trader feels after a series of wins, the market has a way of humbling even the most overconfident. One misjudged trade, one sudden spike in volatility, or a breaking news event can wipe out days or weeks of profit in an instant. That single loss is often a rude awakening, a reminder that no setup is guaranteed. The emotional impact of a big loss after a winning streak is profound. Traders feel betrayed, shocked, and frustrated. All the self-assured thoughts, "I'm a genius," "I figured this out," collapse instantly. This is the moment when the illusion of invincibility shatters. For many, it triggers a psychological reset, forcing them to confront the truth. The market is probabilistic, not predictable. This reality check is painful but essential. It teaches that success in trading is not about being right every time, but about surviving losses and preserving capital. Professionals treat losses as part of the natural flow of trading. They analyze what went wrong objectively, adjust their approach if necessary, and return to the next trade with discipline intact. Amateur, however, often react emotionally. They may try to chase their losses, overtrade, or abandon risk management entirely, which compounds the damage. The key lesson from a humbling loss is to respect the market, adhere to rules, and remember that confidence should never replace strategy. In the end, a big loss is not the end of the journey. It's a teacher. It forces traders to recalibrate their mindset, rebuild discipline, and understand that probability, patience, and risk control are the only real paths to long-term success. Many traders believe that the more they analyze, the more control they have over the market. Charts, indicators, trend lines, economic news, the tools are endless, and the temptation to absorb them all is strong. They tell themselves, "If I study enough, I can predict what the market will do next." This mindset creates an illusion, the belief that knowledge equals control. At first, this approach feels empowering. Every new indicator, every pattern recognition seems to provide a small advantage. Traders spend hours poring over charts, backtesting strategies, and monitoring news feeds, convinced that if they just gather enough data, they can bend the market to their will. The brain interprets this activity as mastery and certainty, but the reality is starkly different. Markets are influenced by countless unpredictable factors: geopolitical events, liquidity shifts, institutional moves, and even random sentiment swings. No amount of analysis can guarantee a result. The more traders try to control outcomes through analysis, the more frustrated they become when trades don't go their way. This illusion leads to dangerous behaviors: overtrading, tweaking strategies endlessly, ignoring risk management, or holding losing positions in the belief that it will come back. Traders become enslaved to the false sense of control their analysis provides, often at the expense of discipline and risk safety. The key lesson is simple: analysis is a tool, not a guarantee. You cannot control the market, but you can control your actions. Risk exposure and adherence to a plan. Professional traders treat charts and indicators as guides, not certainties. They use data to make informed decisions while accepting that uncertainty is the only constant. Mastery comes from controlling yourself, not the market. Once traders believe that analysis gives them control, they often fall into dangerous behaviors. One common mistake is holding losing positions for too long, hoping that the market will eventually reverse. The inner voice says, "I know this setup works. It has to come back." But this belief is rooted in emotion, not logic. The market doesn't care about your conviction. It simply moves according to probabilities. Another typical error is adjusting stop-loss levels to avoid taking a loss. Traders move stops further away, telling themselves, "The market just needs more room." Each adjustment feels rational at the moment, but it exposes the account to larger losses and increases emotional stress over time. This habit erodes discipline and confidence. Adding positions to losing trades averaging down is yet another manifestation of the illusion of control. The trader convinces themselves that they can force the market to align with their analysis. This behavior often multiplies risk exponentially. One unexpected move can wipe out not just the trade, but significant portions of the account. The root cause of these mistakes is the false belief that outcomes are controllable. Markets are probabilistic, not deterministic. Professional traders understand this distinction. They set stop losses, manage position sizes, and accept losses as part of the game. They don't try to manipulate the market. They manage their own behavior. In the end, the lesson is clear. The more you attempt to control the market, the more vulnerable you become. Discipline, adherence to risk rules, and emotional control are the only real areas of mastery. Accepting uncertainty and following your plan protects your capital, preserves your confidence, and ensures longevity in trading. The harsh reality for traders is simple. You cannot control the market. No matter how much analysis you do, how many indicators you follow, or how experienced you are, the outcome of any single trade remains uncertain. Markets are influenced by countless unpredictable factors: breaking news, liquidity changes, institutional moves, and even random sentiment. Trying to control these forces is a guaranteed path to frustration and loss. What traders can control, however, are their actions, risk, and discipline. Setting stop-loss levels, determining position size, and following a predefined trading plan are all within your control. Managing your emotions when a trade goes against you is also a key aspect of this self-control. By focusing on what you can influence, you build resilience and protect your capital. Professional traders internalize this lesson. They don't try to predict every tick or force the market to comply with their analysis. Instead, they treat every trade as a probabilistic event. They accept losses, manage their risk, and focus on executing their plan consistently. Control is about process, not outcome. The difference between amateurs and professionals lies here. Amateurs obsess over market movements they cannot influence, often increasing risk and stress. Professionals concentrate on disciplined execution, understanding that surviving losses and following rules is far more important than being right on every trade. Ultimately, accepting that outcomes are uncertain is liberating. It frees you from the illusion of control and allows you to trade with clarity and discipline. The market will always be unpredictable, but your actions, risk management, and adherence to strategy are tools that ensure long-term survival and growth. One of the most common psychological traps in trading is hope. When a trade moves against a trader, it's natural to feel a flicker of optimism. It will turn around. I just need to wait a little longer. This small hope can quickly spiral into dangerous behavior. Traders hold on to losing positions far beyond what their plan allows, convinced that a reversal is imminent. Hope creates a false sense of control. The trader believes that patience and willpower alone can bend the market in their favor. They ignore the rules they set for themselves. moving stop losses, or refusing to exit a trade. Each passing moment reinforces the illusion that the trade just needs more time, while the market continues to operate independently, indifferent to human desire. The danger of the hope trap is compounded by emotion. As losses grow, fear and anxiety increase. Yet hope persists, compelling the trader to cling even harder. This combination of hope and emotional investment often leads to revenge trading, where decisions are made to make back lost money rather than follow strategy. The longer a trader relies on hope, the greater the potential damage to both capital and confidence. Professional traders treat hope as a signal, not a guide. They set exit rules, honor, stop-loss levels, and accept that losses are part of probabilistic outcomes. Hope without a plan is a liability. Hope with discipline becomes irrelevant because the trader acts according to rules, not emotion. The key takeaway: hope can be deadly in trading if it overrides strategy. Recognizing when hope is influencing decisions allows traders to step back, follow their plan, and protect both capital and mindset. FOMO, or the fear of missing out, is a psychological trap that tempts traders into impulsive decisions when a market moves rapidly or when a big move occurs without them in the trade. Traders often feel an intense pressure. What if this is the move of the day? What if I miss it? That fear can override logic, causing traders to enter positions hastily, ignore risk rules, or bypass analysis entirely. FOMO-driven trades are rarely strategic. Instead of waiting for setups that fit their plan, traders chase the market. They may jump in late, with poor entry points, and often without proper stop-loss levels. The emotional urgency gives the illusion of action, but in reality, it increases risk and reduces the chance of success. The danger is compounded because the brain seeks immediate reward. Seeing a rapid price movement activates dopamine, which reinforces the behavior of jumping in without proper preparation. Traders repeat this pattern, thinking that constant action equals opportunity, while the reality is that overtrading usually leads to losses. Professional traders treat FOMO as a warning sign rather than a call to action. They remind themselves that missing a single move is not catastrophic, and that consistency and discipline are far more valuable than chasing excitement. The key is patience, waiting for high-probability setups, following the plan, and controlling risk. Ultimately, FOMO can destroy accounts faster than any technical error. Recognizing it, slowing down, and acting only according to rules separates professionals from amateurs. Understanding that opportunities are endless in the market allows traders to trade calmly, preserving both capital and mental clarity. Some traders struggle with the need for constant action. Sitting idle can feel uncomfortable or even wrong, as if doing nothing means missing out on potential profits. The mind equates inaction with failure, which can drive traders to enter trades even when no proper setup exists. This compulsive behavior is often mistaken for diligence, but it usually results in overtrading and poor decision-making. The problem is that not every moment in the market offers a high-probability opportunity. Markets are naturally intermittent, with periods of calm and noise between real trends. Traders who cannot tolerate waiting interpret these quiet periods as lost time, forcing themselves into trades that do not meet their criteria. The result is stress, impulsive décision, and increased risk exposure. This behavior is amplified by emotions, fear of missing out, anxiety, or boredom can push traders to act prematurely. Each unnecessary trade reinforces the pattern, creating a loop where action feels productive, but in reality, it often erodes capital. Over time, the trader becomes reactive, rather than strategic, responding to price movements instead of executing a plan. Professional traders understand that patience is a strategy. Waiting for setups that fit predefined criteria is often more profitable than constant trading. They view inaction not as a weakness, but as a disciplined approach to preserve capital and maintain clarity. Markets offer endless opportunities. Missing one is not catastrophic. The key lesson: the need to constantly act is a psychological trap. Recognizing it allows traders to pause, evaluate, and only enter trades that align with their plan. Mastery in trading is not measured by how often you trade, but by how consistently you follow a strategy that controls risk and preserves capital. The first step to breaking free from the traps of trading psychology is brutal honesty. This means acknowledging a simple but powerful truth. You do not know what will happen next. Not in the next minute, the next hour, or even the next day. Markets are inherently uncertain, and no amount of analysis, experience, or intuition can change that fact. Brutal honesty forces traders to confront their ego. Many believe that past study, hours of charting, or a string of wins guarantees future success. This is a dangerous illusion. Accepting that you can be wrong and that losses are inevitable shifts your mindset from gambling to managing probabilities. You stop asking, "Will this trade win?" and start asking, "What happens if it doesn't?" Acknowledging uncertainty also encourages discipline and risk management. Once you admit that you cannot control outcomes, you focus on what you can control: position size, stop-loss levels, and adherence to your trading plan. You begin to plan for the worst-case scenario on every trade, reducing emotional stress and preserving capital. Professional traders embrace brutal honesty as a daily practice. They know that the market owes them nothing, and certainty is an illusion. By accepting this reality, they trade with clarity and composure. They detach from the need to be right on every trade, and instead prioritize survival, consistency, and process execution. In short, brutal honesty is a mindset shift that separates amateurs from professionals. It removes the illusion of control, instills humility, and empowers traders to make decisions based on strategy rather than hope. Fear, or ego. Accepting that you don't know what will happen next is not weakness. It is the cornerstone of long-term trading success. Once a trader embraces brutal honesty, the next critical step is shifting the mindset from prediction to probability management. Most beginners approach trading as if they can forecast the future. This trade will win because the pattern worked before. This mindset is inherently flawed because markets are probabilistic, not deterministic. Even the best setup can fail, and the next candle may move unpredictably. Managing probabilities means accepting that every trade carries a chance of loss, no matter how confident you feel. Instead of asking, "Will this trade work?" you begin asking, "What are the odds? And how much am I willing to risk if it doesn't?" This subtle shift changes everything. It turns trading from a game of prediction into a game of risk management and expectation control. One practical way to implement this mindset is through scenario planning. Before entering a trade, the trader evaluates both the best case and worst case outcomes. What happens if the market moves in your favor? How much can you gain? And crucially, what happens if the trade goes against you? How much can you afford to lose without jeopardizing your account? Thinking in terms of probabilities rather than certainties helps remove emotion from decisions. Another key aspect is position sizing. Managing the amount risked per trade is a direct application of probability management, even if the setup seems perfect. Controlling the size ensures that a loss will not destroy your account. This creates a buffer that allows the trader to survive through a series of unfavorable outcomes, reinforcing the idea that no single trade defines success, probability-focused trading also reduces the urge to chase perfection. Traders no longer look for the Holy Grail system or a guaranteed win. Instead, they accept that losses are part of the process and that consistent, disciplined execution over time is what produces long-term results. Emotional decisions, driven by fear, I hope, or overconfidence, are minimized when the focus shifts to risk, probabilities, and contingencies. Finally, this mindset fosters resilience and discipline. By planning for worst-case scenarios, respecting risk limits, and maintaining objectivity, traders cultivate mental toughness. They learn to treat losses as expected events rather than personal failures. In this way, trading becomes less about trying to predict the unpredictable and more about navigating uncertainty intelligently. The market remains chaotic, but the trader's response is controlled, measured, and rational. In summary, shifting from prediction to probability management transforms your approach. It replaces fear and hope with calculated risk, impulsive decisions with structured plans, and illusions of certainty with realistic expectations. Traders who master this mindset consistently survive and thrive, regardless of individual trade outcomes. After accepting uncertainty and embracing probability management, the next critical step is to focus on process rather than outcomes. Trading success is not determined by whether each trade wins or loses, but by how consistently you follow a structured plan. By concentrating on execution, position sizing, and risk management, you maintain control over what truly matters. One of the most effective ways to apply this mindset is through small, calculated risks. Even if a trade goes against you, risking only a small portion of your account ensures that losses are manageable. This reduces emotional pressure and prevents a single trade from derailing your confidence or capital. It's not about avoiding losses. Losses are inevitable, but about surviving them and staying in the game. Discipline is another cornerstone of process-focused trading. Consistently following your rules, even when tempted by emotions, builds reliability and predictability into your approach. Discipline prevents you from chasing trades out of fear or greed, from overtrading, and from adjusting stops impulsively. It transforms trading from a reactive activity into a controlled, methodical practice. Equally important is emotional stability. Market swings, winning streaks, or losing streaks can all trigger strong emotional reactions. Traders who remain calm and objective are better equipped to execute their plan and manage risk effectively. Emotional resilience allows you to respond rationally to losses, resist impulsive trades, and avoid letting euphoria from wins cloud judgment. Professional traders know that the only factors within their control are process, risk, and mindset. By focusing on these areas, they remove unnecessary stress and reduce the impact of unpredictable market movements. They measure success by adherence to rules and consistency, not by the outcome of any single trade. In short, process-focused trading is about controlling what you can: position size, execution, and discipline, and letting the market do what it will. Risk management, consiste exécution, and emotional stability form a trifecta that ensures survival and long-term growth. By committing to the process, traders protect their capital, preserve their confidence, and build the foundation for sustainable success. The market is inherently chaotic. No matter how much experience, analysis, or strategy a trader possesses, the market will always behave unpredictably. This is the fundamental reality. You cannot control the market. Attempting to predict every movement or forcing outcomes only leads to frustration, loss, and emotional burnout. The key takeaway is clear long-term success comes from controlling yourself, not the market. This means managing your risk, sticking to your plan, following your rules, and maintaining emotional discipline. Traders who survive and thrive focus on process rather than outcome, and they understand that losses are part of the game, not personal failures. Every trader will encounter losses, missed opportunities, and unexpected market movements. The difference between amateurs and professionals lies in their reaction. Amateurs chase certainty, fight the market, and make impulsive decisions based on fear or hope. Professionals accept uncertainty, follow their rules, and focus on executing their strategy consistently. Survival and long-term growth come from self-control, not luck or perfect predictions. As a practical step, ask yourself, am I trying to control something I cannot? Each time you feel compelled to force a trade or hold a losing position, pause and reflect. Recognize that opportunities in the market are endless, but your capital and confidence are finite. By prioritizing discipline, process, and risk management, you protect both. The market will always move in unpredictable ways, but by mastering yourself, you create a sustainable edge. Survival, consistency, and rational decision-making are the real measures of success in trading. The sooner you accept this, the sooner you stop fighting the market and start flowing with it. Every trader who thrives knows this truth. Control your actions, respect risk, and let the market do what it will. As we close, here's a question worth reflecting on. Are you truly free in your trading? Or have you built a comfortable prison without realizing it? Many traders mistake comfort for freedom. They stick to habits that feel safe, chasing certainty, avoiding risk, ignoring discipline because it feels easier in the moment. But in reality, those habits are what keep them trapped. The truth is, growth never comes from comfort. Progress requires stepping into uncertainty, embracing discomfort, and being brutally honest with yourself. Every time you choose discipline over impulse, patience over FOMO, or risk control over reckless hope, you're breaking free from the prison of bad trading psychology. So here's the challenge. Take a hard look at your own trading. What's one habit you know is holding you back? Is it moving your stop-loss out of hope? Is it doubling down after a loss? Is it chasing trades because you can't stand waiting? Acknowledge it and commit to letting it go. If you're serious about evolving as a trader, stop searching for certainty and start building resilience. The market doesn't care about your comfort zone, but your future as a trader depends on your ability to leave it behind. Now it's your turn. What's one comfort you're willing to give up today to move closer to the trader and the life you truly want? Share it in the comments below, because the moment you declare it, you've already taken the first step out of the prison and onto the path of real freedom. At the end of the day, trading is not about controlling the market. It's about controlling yourself. The market will always be chaotic, unpredictable, and indifferent to your hopes or fears. But within that chaos, you still have power. The power to manage risk, to follow your plan, and to stay disciplined when emotions try to take over. Successful traders are not those who predict every move, but those who survive long enough to let probabilities play out. They accept losses without panic, wins without arrogance, and approach each trade with clarity. Their edge is not certainty, but consistency. Remember this simple truth: every time you fight the market, you lose. Every time you control yourself, you win.